What's up, everyone? Erik here from Outlier Trading, and today we're going to talk about the process of building an options trade. Because my guess is a lot of people, they actually start the process kind of backwards, where we say, oh, I'm going to sell a vertical, or oh, I'm going to buy an iron condor. And I want to walk you through a different way of thinking about this that might actually make more sense for you. So let's go right into it. The very first thing we have, as you know, is our disclaimer. I am not affiliated with Barchart. I'm not a financial advisor. I'm here just sharing information, hopefully, to help people add tools to their toolkit. I enjoy making content with my friends over at Barchart. So let's get the process started. First, I'm going to walk you through 4 big steps. I call it the big 4 trading steps that you probably should consider. Then I'm going to walk you through step by step the key decisions that should be made for every single options trade. And the idea behind all of this is to help you build a framework around what you might want to place your trade on, ideally so that things mirror the thesis, what you think something might do, and how you build the supporting options trade around it. Because the cool part about options is that they're very, very strategic. You can mess with a lot of little things here and there that allow us to take on the exact type of risk and ideally opportunity that we want to have. So what does this 4-step process look like? Well, these are kind of the big steps. We're going to go through these pretty quickly. But before we even decide if we're going to buy a vertical, sell single options, buy single options, trade a diagonal, the very first step here is actually to define clearly the profit mechanism. What is a profit mechanism? Simply put, it is the specific thing that makes you money in your trade, provided things go our direction. So what does that look like? Well, let's take a look over here, for example. And if we're looking at XLU, and let's say that we think XLU is going to keep going up. Utilities have been showing relative strength compared to the other indices. So let's just say we're bullish here. For whatever reason, it's a hypothetical. Well, what's the profit mechanism? If I wanted to trade this thing to the upside, the specific profit mechanism here is price direction, in this case, going up. And you might say, duh, we're talking about trading something bullish. But that's the first step. Then we need to actually click in one more layer and understand the specific profit mechanism. Because, for example, if I told you that price direction up is a profit mechanism, I don't think that surprises anybody. But would you say that all things that go up look the exact same? I would argue not. For example, if we move from XLU to within XLU and we take a look at something like CEG, what do you notice about price direction up here? Well, here I'm looking at something that moved essentially from 170 to 268 over the course of a couple weeks. Here, if I look at XLU over the same couple weeks, we've gone essentially from 75 to 80. So then the way that I would trade these, if I had a crystal ball and could predict direction, which obviously if I place a trade, it's going to go the exact opposite of what I pick. But jokes aside, what I'm highlighting is the way that I would set these trades up if I did have a crystal ball and I could see that these things move differently. I wouldn't trade them the same way. And we'll talk about why and why this is so important. So that's the very first step here, is thinking about our profit mechanism. After we go through our profit mechanism, actually, let's talk about this crystal ball methodology, and we'll talk about the mechanism signal. This is how we try and forecast probabilistically what something might do in the future. So again, going back to our example here, if I think XLU is going to go up and continue up, how do I know with any idea what it might look like? Well, while the past performance doesn't guarantee future performance, it tends to look pretty similar. So for example, if I wanted to know what the weather is going to be like tomorrow, I can look at what the weather was like today or yesterday, And it's probably pretty close. Sometimes it's not. Sometimes it will change, and sometimes things will change very quickly. A good example of this actually is CEG, because it started this really strong rise, but then it exploded up above beyond that. But still, there are different qualities that I can eyeball and different signals that help me find them. So the idea behind mechanism signals is to, once we understand the profit mechanism, we want to fit signals that help us find it. So for example, if I'm talking about price direction up, and in this case, I'm talking about something that looks like it drifts a little bit more, or if it has a momentum element to it, as compared to something like this that has a breakout momentum element to it, right? There's a little bit of momentum here, but then it's followed by a breakout. The way that I would look for things like that is slightly different. So when I'm looking at things like overall momentum, I'm looking at things like upward sloping linear regression channels. I'm looking at things like moving averages organized with short-term moving averages above long-term moving averages, both of which should be positive sloping. I'm looking at price above both of those. I'm looking at neat, orderly pullbacks, and so on and so forth. Whatever your process is to create signals to help you identify the profit mechanism, that's our best possible approach at the crystal ball idea in having a probabilistic assessment of what might happen in the future. Okay, so you'll notice that this is about building an options trade, and we haven't even said the word options yet. Why? What's up with that? Well, it's because these two steps matter the most. Because it doesn't matter if I have a profit mechanism direction up, I have signals that help me see it perceivably. If I don't do that first, then it doesn't matter what option I select, what structure I use. If I don't have these in order first, then I'm out blind. I'm walking with no real objective because I'm starting over here and I'm saying something like, oh, I want to sell verticals. Well, does it make sense to sell a vertical if something is going in the other direction? If I want to sell a put vertical, I want something to go up. If I'm not able to find things that are going up, then it doesn't really matter. We have to put first things first. So that's why the first part of this video is talking about profit mechanisms and signals, because now we get to build the trade. So how do we build our trade? We're going to look at a few really important steps. Things like determining how we're going to manage our profit and loss. We're going to look at things like a trade checklist. We're going to have a trade log ready to put data into. And then once we get through building a trade, it's essentially when we execute and then follow up. So let's get further into this over here, this idea of building a trade. What are the key decisions that need to be made? Well, these are most of them. There's one important one missing that we're going to get to at the end. But this is what we have to determine when we're building an options trade, because options have expirations and we have to be sensitive to those expirations. So as we look across these, that tells me every single time we place an options trade, it does not last forever. So there's now a very important timing component to what we're doing. The other thing is understanding the differences between different option structures. So for example, if I have a portfolio that's generally heavily utilized right now, meaning I'm using a lot of my money, maybe I don't want to use a strategy that has undefined risk. So the main decision point here is, do I want defined versus undefined risk or profit, depending on the opportunity? Because if I'm selling premium, I'm going to have undefined risk and defined profit. And maybe that makes sense for the opportunity that I look at. Because say, for example, we're looking at something like XLU. Let's say we think it's going to go up, but we don't necessarily think it's going to go up a whole bunch. So we're not looking at like a breakout style profit mechanism, but we're looking at drift. Well, maybe we can sell options here because it gives us a little bit of a buffer if we sell some puts. And if it goes up a little bit or even goes sideways, we would make money. But we're not worried about missing out a massive move to the upside like we might be concerned with CEG because of a different profit mechanism. That is one of the ways that we can inform which of these make the most sense. The cool part about building an options trade is that it's literally just a series of trade-offs. So if I'm going to take something that has defined risk and undefined profit, those are typically lower probability plays. And then the inverse is true. If I'm defining my profit and have undefined risk, those typically will have higher probabilistic outcomes favorable to the position. So this leads into the next 2 points, which are pretty straightforward, but specifically the ability to calculate the probability for the trade, which we can use options to do that. Why do I care about calculating my probabilities? It's so that I can calculate my expected return, which is my ultimate risk and reward for the position. And again, we can use options to do this. So if we take a look at the delta for near-term options, now this is an important caveat, near-term options. As soon as you start going further out in time, using delta as an approximation for probabilities breaks down pretty significantly. So anything within 30 days or so, it's okay to use the back of the napkin tool for probabilities via delta. And we can say, okay, what's the probability of XLU hitting 82 by the 27th of September? Well, I can just take a look at the delta and I can say, well, it's an 11% probability-ish of it being in the money, or a probability of a touch is 2 times that, 22% probability roundabout. So I can use options to give me probabilities so then I can calculate my expected return. Because if I'm buying something and I'm risking $1,000 to make $100, there has to be a really good probabilistic edge in that trade in order for it to make any remote sense. Now we get into the remaining details, and this is actually where it gets a little simpler. We have the choice for DTE, and your choice is pretty straightforward. Do we want to select DTE that's longer or shorter in time? What are the trade-offs with that? Well, the longer we pick, the more extrinsic value in the options. We also know things like gamma are going to slow down if you go further out in time. So those kinds of things help us understand as we're selecting individual legs for our trade, what make the most sense. Delta. Do we want something with a higher delta or a lower delta? And again, we could take a look at an example. If I'm buying an option, maybe I want something with a higher delta so that if I get an accommodating move in my favor, I move better dollar for dollar with the underlying. What's the trade-off? It's going to be slightly more expensive. So if I'm choosing something that's really far out in time that I know has a low gamma, maybe I pick something that has a higher delta, so that if I do get a price accommodation, it moves in my favor. I actually realize more of a profit. Maybe it's the opposite if I'm selling options. If I wanted to come in here and sell a call, maybe I'll go to a slightly lower delta, maybe this 32 delta or even this 11 delta, so that there's a higher probability of my option not being in the money. What's the trade-off? Well, if I pick the 11 delta, I'm going to collect less of a credit. If I pick the higher delta, I get a higher credit, but a higher probability of my option being challenged. Couple more here. We already talked about gamma. Gamma just tells us how fast delta changes. So if I'm buying options, I want gamma. I want my options to compound quickly. If I'm selling options, gamma can hurt me. So then we have to strike a balance with the amount of time we select with an option. And notice how for theta, I say optimization, because theta is a really interesting component to any sort of options trade, whether we're buying or selling options. So for example, if I'm choosing to sell options, well, we would say maybe we want to go in as far out as possible, because I just told you that if we go really far out in time, that there's more extrinsic value. There's more theta that can come out of the options in total. Yes. However, theta decay, the rate that theta comes out of the options, is actually higher when you're within 60 days to expiration. But as you get closer to expiration, what do we know about gamma? Gamma gets higher. So if I'm selling options, I have to think about which of those trade-offs makes the most sense for my position. So The summary of this is when you're thinking about building an options trade, you should think about the profit mechanism that you're trying to exploit, the signals that help you find it. Then, as we're building the trade, we have to optimize the structure of the trade based on these two components. And then these different elements inform what makes the most sense for us. So again, a quick example. Let's say that I'm bullish in XLU and I think it's going to go up over the next 3 months. Would I want to buy 1 week options? No, it's not enough time for me to play out my thesis. So I know I need to go further out in time. So by simply breaking your ideas down into smaller components, all of these different decisions become much easier to make because it's very clear what we're trying to optimize for. Now, the last thing is management. When we are trading options, you have to manage by 2 different things. Price, meaning the movement of the underlying and the performance of your trade itself, but then also by time, because all options expire for better or for worse. So you have to have an idea of what you're going to do with your trade before you place it. So if the video is useful, let me know and we can do a follow-up where we work through full examples so that you can get an idea of what this looks like when it's all put together. But otherwise, you can start taking these individual components, thinking about how you can apply it to your approach to make better trading decisions. As always, let me know if you have any questions. Be an outlier. I'll see you all later.